At an enterprise level, nothing is more important than communication. Grammarly for Enterprise enables your company to work smarter and faster. Other AI tools can't quantify business impact, but Grammarly gives you actionable insights and measurable results with features like their effective communication score, which tracks key metrics so you can make data-driven decisions to improve outcomes. Visit Grammarly.com/enterprise. That's Grammarly.com/enterprise.
People really don't know what their expenses will be because they don't know how long that they're going to live.
Americans are worried they won't have enough saved for retirement now more than ever.
Retirement is going to cost for many folks over $1 million.
Is no sure thing in investing, but a lot of people think that annuities may come close to that.
It's going to more safe things that they know. If they know they're going to need that money to supplement their retirement, well, then you can't play that risk.
This is the Safe Money and Retirement Show with Jon Heischman Sr., founder and partner of Heischman Financial Services, serving the Columbus and surrounding areas. Jon specializes in educating pre-retirees and retirees about safe money strategies and ideas. Now, it's the Safe Money and Retirement Show. Here's Jon Heischman Sr.
Diversification is absolutely the most fundamental principle of successful retirement planning. I want to talk about that on this segment of Safe Money and Retirement. I'm your host, Jon Heischman. I want to thank you for joining me, and feel free to contact me with your questions and concerns that apply to your planning. 888-426-0177. I'll give that number to you again. I will repeat it throughout the show, but again, that number is 888-426-0177. And visit the website HeischmanFS.com. And that is spelled HeischmanFS.com. Past radio shows and podcasts are available, as well as a lot of good information that can help you with your retirement planning. All right, diversification is unique, in my opinion. A lack of diversification puts you at more risk, yet doesn't necessarily offer you a higher chance of return. So many times we think of risk as money in the market, the potential of losing money. But here, a diversification risk also exists when you put all of your eggs in one basket, such as the bank, which could take a much greater risk because you didn't get a greater return in exchange for this type of higher risk. And I do not mean putting your money into 8 different banks or 8 different investment companies. This is not considered diversification, nor putting all of your money in one family of funds or stocks. So we have to address diversification because it means your money is separated by type of investment, by category, by area of economic or world geographically or socially. Diversification can be based on maturities, income streams, any number of factors. When I talk about diversification for my clients, I have to take into consideration their risk tolerance and then diversify from there. Whatever you choose to do, please do not violate this rule by not diversifying. You must diversify because included in diversification is safety. It protects you against the unknown, the unforeseen changes in the economy and financial world. And we have surely seen this over the past. If things go bad in one area, it's very likely they'll go up in another area. For example, if the stock market is down, gold prices might be up. If CDs are paying more, bonds might be down. So there's always this give and take in the world of investments, just like everything in life. So I mentioned investments, and when it comes to retirement planning, investments are critical because it's going to be part of your retirement plan, because more than likely it's going to generate income. And really, isn't that the key in retirement? Making sure you have income, adequate income that's going to last you the rest of your life. Once that is established, let's invest. Let's be a little risky, depending on your age and risk tolerance, and try and get the maximum growth. If you do lose money, you still have your income in place. When I talk to a referral or a radio listener, and they're concerned about making sure the money that they have for retirement is going to generate and be guaranteed that the income is going to be there for the rest of their retirement, they typically don't know if they're diversified to the point where their money is protected regardless of what we may face in the future. And that's why I encourage you to address this situation at the early stages of your retirement. Now, it's never too late to make changes to your plan and to make sure you're diversified, but usually as soon as possible. I offer a free consultation and absolutely no obligation to review your plan or give you a second opinion as to how you're diversified. Whether you want to schedule a personal meeting or schedule a telephone conversation, let me know. 888-426-0177, 888-426-0177. Earlier, I mentioned risk and how it applies to diversification. And actually, risk is a misunderstood concept, which most people think of in the wrong way. People think of risk as putting money in an investment and having their principal value reduced or lost. All this is true of one type of risk, but we need to briefly explain how we think risk really works and how you should view risk. There are several types of risk in the retirement planning world that I'd like to discuss. Now, I want you to keep in mind, I'm not trying to create a doctoral thesis on the explanation of risk. There are hundreds of theories and ideas on how many kinds of risks there are, what they are, and how they can be measured and quantified. I'm here to talk about your world and life as it pertains to retirement planning, not some professor's view or a book or TV commercial. your individual situation, and I guarantee you it's probably going to be different than your neighbors, your friends, and family members. So the discussion of risk is meant to be brief, realistic, and hopefully useful to you to where you can visualize your situation. A type of risk that needs to be addressed is the risk of loss of principal. This is a pretty easy risk to understand. This is the type of risk where, for example, you put money into an investment, let's say $10 a share, and it goes down to $2 a share. Therefore, you've lost $8 a share on your principal because of the change in value. Now, these changes in value can occur for all kinds of reasons, such as market changes, interest rate changes, economic changes, government changes in tax laws, or other laws. There's all kinds of reasons for you to lose your principal. Another kind of risk is loss of purchasing power, or another way of saying it's the risk that inflation will destroy the value of your money. Boy, we have seen that recently, haven't we? If you buy stock at $10 and it goes down to $2, it is a loss of principal and you sell. A real loss of money. And this is an easy one for people to understand, and they've seen this happen. Even though none of us like it, it is comprehensible and market sense. But the loss of purchasing power just as surely destroys principal and causes you to lose money. But it is understood by most people because it is not easily seen typically unless we see a large jump in inflation, which we've seen recently. And overall, I think most people do a good job of investing to protect at least some of their retirement assets from loss of principal. However, very few people understand the risk of loss of purchasing power. I've talked about the details of inflation and want to stress that inflation's destructive power over your financial life and security is probably the most underestimated, misunderstood risk that you're going to face. Your plan, your income sources need to be protected against inflation. Contact my office in the event you would like to discuss any topic, whether I talked about it on the show or not. Answer your questions and concerns. 888-426-0177. A meeting can be scheduled in my office or at your home. It's your retirement, and regardless the size of your accounts, that's your money, and it's got to last a lifetime. I'm going to take a short break at this time, but stay with me. I'll be right back.
Thanks for listening to the Safe Money and Retirement Show with Jon Heischman. For more information, call 1-888-426-0177. That's 1-888-426-0177. Or visit their website at HeischmanFS.com. More of the Safe Money and Retirement Show in a moment.
With healthcare costs expected to continue to increase faster than the inflation rate, the time to take a look at your future healthcare is now. Not in retirement, but if at all possible before retirement. If you've already retired, it still isn't too late. A lot of the cost can be controlled. We work out a plan how to cover the increase cost that we're all going to be faced with. And believe me, I think it's probably going to be the number one increasing cost that we're all going to see in retirement. You want to talk further? You can give me a call. 888-426-0177. 888-426-0177.
Life expectancy is at all-time highs, so that means you've got a future to plan for at any age. If you have longevity in your family tree, then you need financial education from someone with the experience and knowledge to guide you into and through your retirement years. Jon Heischman and the folks at Heischman Financial Services are committed to helping you achieve your retirement goals with a low-key and trustworthy approach. Call Heischman Financial Services today to get started on your retirement future. Call 1-888-426-0177. That's 1-888-426-0177. Heischman Financial Services has your future in mind.
Welcome back to the Safe Money and Retirement Show with Jon Heischman. To contact Jon, the number to call is 1-888-426-0177. That's 1-888-426-0177. Once again, here's Jon Heischman.
Welcome back to the Safe Money and Retirement Show. I'm Jon Heischman. Another way to diversify.
At your job, do you ever have to deal with a nose roller? How about a snub pulley? Well, if you're installing a new conveyor belt system, dealing with the different components can sound like you're speaking a foreign language. Luckily, you've got a team ready to help. Grainger's technical product specialists are fluent in maintenance, repair, and operations. So whenever you want to talk shop, just reach out. Call, click Grainger.com, or just stop by. Grainger, for the ones who get it done.
Diversification and taxation. The risk of taxation. Just another thing that causes you to lose money, because if you lose money to income taxes, estate taxes, or even gift taxes, you have again lost money and principal. If you sell an investment for $10,000 and paid $2,800 in taxes, you keep only $7,200. Haven't you lost about 28% of your asset? Isn't losing 28% of your asset a loss of principal? It is no different of a risk than any other, but also very misunderstood risk. In retirement, I think tax planning is so critical and important. You must have a plan to figure out what your situation is, find out what tax strategies are available to you, and be able to reduce your taxes as low as possible using the tax-advantaged plans and strategies that are available. The way you invest your money, it's going to have an enormous impact on this risk because very simply, you don't want to lose money to taxation. Now, keep in mind that this risk of losing money to taxes is very much under your own control. Unlike the risk of losing values because the principal drops on a security, it's out of your control, but the amount that you pay the IRS or any taxes is under your control. And I'll give you an example. you could invest in a CD and choose to pay the maximum amount of tax possible. Or you could choose to have money in an IRA or a tax-deferred annuity and have the taxes on the income deferred until some point in the future. The key here is deferral, because deferring taxes, it's not going to eliminate them, but the compounding effect of having an investment's tax-deferred earnings reinvested as opposed to having taxes paid along the way is going to build a much larger value over time. That's why when we compare a bank CD to a tax-deferred annuity, and assuming the terms are the same, with the CD, you're going to pay taxes as earned from the CD, whereas the tax-deferred annuity, the tax is deferred until a withdrawal is made. And unfortunately, too many people don't realize this comparison. Now, things have changed simply because the short-term annuity rates have been so high over the last couple of years. You can still have that bank CD, but you also need to diversify by having some money that you don't need in the tax-deferred annuity concept. A lot of this boils down to common sense and a little technical knowledge about investments. It will serve you much better than extraordinary technical knowledge about investments, because so many times those in the investment world make things very confusing, very complicated, and the average person doesn't know what's going on. And back to what I said earlier, it is critical to have income sources in place. That's part of the diversification plan. And in your plan, there needs to be forms of guarantees. Obviously, the guarantees reduce risk, but can cause an even greater risk. And I think the best example is bank money, such as CDs, savings accounts, etc. Now, with this type of safe money, as we see in banks, you have the guarantee of principal, but you have no guarantees against loss of purchasing power or loss by taxation. And don't misunderstand me. I'm not saying don't have money in the bank because it's critical. We all need that emergency fund, liquidity available. The question is, how much? And I think everybody's different as far as their comfort zone on what they should have as an emergency reserve fund. So to sum up diversification, your portfolio retirement plan needs to be diversified. It must have the opportunity for growth, hedge against inflation, and give you the best chance of realizing your goals so you can have a secure and peaceful retirement without worry, using common sense approaches to investing. It's going to allow you to sleep much better at night and know that in 10 or 15 years down the road in retirement, you're still going to have a guaranteed source of income coming in. So think about investment is defined as to commit or use money or capital for the purchase of property or a business with the expectation of profit. Diversification, it's defined as separating your money by types of investment, categories, and areas of the economic world, geographically or socially. Diversification can be based on maturities, income streams, or any number of other factors. You must diversify your plan. Diversification is the most fundamental principle of successful investing, and a lack of diversification puts you at more risk and doesn't necessarily give you a higher chance of return. Don't put all your eggs in one basket, because we don't want to risk the loss of principal or risk of loss of purchasing power, meaning inflation. And keep in mind, risk of losing money to inflation is the most misunderstood and largest risk retirees face. It can destroy a retirement plan probably more than any other loss, and even loss of principal. And don't forget about the risk of taxation. Again, check your plan or have it reviewed. Are you diversified? If you're not sure, based on what I've been talking about, call me. We can talk about it. Take advantage of the fact that I will not charge you anything or obligate you in any way. It's my way of thanking you for taking the time to listen to the Safe Money and Retirement Show. Let me give you the number one more time. It's 888-426-0177. That's 888-426-0177. I'm your host, Jon Heischman, and thank you for joining me.
The Safe Money and Retirement Show with Jon Heischman Sr. To get in touch with Jon, call 1-888-426-0177. That's 1-888-426-0177. For more information about Heischman Financial Services, visit their website, HeischmanFS.com. That's HeischmanFS.com. Join us again next time for the Safe Money and Retirement Show with Jon Heischman Sr.